This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers identifying the options for housing and the housing market, identifying the financing for purchasing a home, and purchasing and owning your home. When considering housing, one of the first decisions that needs to be made is whether to rent or buy. There are advantages and disadvantages with each. Renting offers the advantages of allowing for more mobility, low or no maintenance, and increased liquidity. The disadvantages of renting include not storing value as one would with investing in a home, no equity growth as one would have with owning a home, and limitations that include possibly not being able to have pets or make certain modifications or renovations that one might like. The benefits of owning a home include the asset being a good store of value, possible equity growth, and mortgage interest being tax deductible. On the negative side, buying a home requires a down payment and sizable mortgage payments that cause one to have less liquidity. In addition, buying a home ties one down to a specific area for at least as long as it would take to sell the home, and is a big commitment and a financial obligation that often runs into the hundreds of thousands of dollars. There are many decisions to make when looking to buy a home. Will it be a traditional single-unit home or a multiple-unit home? The multiple-unit dwelling can be used to create rental income or to house extended family members, but this choice imposes the responsibilities of being a landlord and also limits privacy. Mobile homes are large trailers fitted with utility connections that can be installed on permanent sites and used as residences. A mobile home may also be situated in a trailer park or mobile home community where the owner rents a lot. Mobile homes are often referred to as manufactured homes, and other examples of manufactured homes are prefabricated or modular homes, which are moved to a foundation site by trailer and then assembled. In a condominium, the homeowner owns a unit in a multiple unit dwelling. Condo owners pay a fee to cover the costs of overall building maintenance and operating expenses for common areas. Cooperative housing is common in some cities and is a unit in a building or complex owned by a nonprofit association or a corporation for the residents' use. Residents do not own the units but rather own shares in the cooperative association, which entitles them to the right to dwell in the housing units. While there are a number of choices you must make that are not listed here, this page shows the choices that often influence which home will be purchased. How many bedrooms and baths will you want? How much privacy do you desire? What location is best for you? Is it near your work? And how are the schools in the area? How much can you afford? Since most of us must apply for a mortgage, we will be limited in the amount of money we can borrow. So that helps determine the price range of home we can afford. Lenders will want to know you can pay your mortgage each month, so they have some guidelines they follow when approving home loans. Usually lenders estimate about 33% of your monthly gross income should go towards your monthly housing costs, or principal, interest, taxes, and insurance. If you have other debts, your mortgage payment plus your other debt repayments should be no more than about 38% of your gross income. Those percentages will be adjusted for income level, credit score, and amount of the down payment. This chart shows that someone with a $60,000 gross annual income would qualify for a home that was just under $200,000 if they paid a 20% down payment. Of course, lenders have the ability to make their own decisions, so it is possible that someone with a $60,000 gross annual income would qualify for a smaller or a larger mortgage. As with a car, it is best to hire a professional to do a home inspection before deciding to buy a particular home. The American Association of Home Inspectors can help you find a licensed professional home inspector in your area. A professional will be able to spot not only potential problems but also evidence of past problems that may have been fixed improperly or that may recur. For example, water in the basement or leaks in the roof. If there are problems, you will need to estimate for the cost of fixing them. If there are significant and immediate repair or renovation costs projected by the home's condition, you may try to reduce the purchase price of the property by those costs. You don't want any surprises after you buy the house, especially costly ones. Most homes cost many times one's annual salary, so a home mortgage is required. Mortgages can be tailored many different ways, but it is fairly typical to choose between paying the mortgage off in 15 years or 30 years. It is also common to choose between an adjustable rate mortgage, that is, one that has an interest rate that adjusts or varies, and a fixed rate mortgage, which is a set rate for the entire period of the mortgage. The down payment is the amount of the purchase price paid in cash by the buyer upon purchase. Most buyers use cash from savings, the proceeds of a house they are selling, or a family gift for the down payment. The larger the down payment, the lower the mortgage payment. While some banks have loans that are designed for no down payments or very low down payments, it is fairly common for the buyer to pay a 20% down payment. As you can see here, the monthly mortgage payment for a $250,000 home at a 5% interest rate is $989.58 if the buyer puts only 5% down on the home, but lowers to $833.33 if the buyer makes a 20% down payment. Other costs of a house purchase are transaction costs, that is, costs of making the transaction happen that are not direct costs of either the home or the financing. These are referred to as closing costs, as they are paid at the closing, the meeting between buyer and seller where the ownership and loan documents are signed and the property is actually transferred. The buyer pays these closing costs, including the appraisal fee, title insurance, and filing fee for the deed. When property need care, even a new home will have repair and maintenance costs. These costs are now a part of your living expenses or operating budget. Over time, you may need to do things like replace the windows, repair or replace the shingles, install new carpeting, or install a fence for your children and/or pets. It can be difficult, but it is not impossible to appropriately budget for these repairs, replacements, and renovations. Some mortgages have an early payment penalty that fines the borrower for repaying the loan before it is due, but most do not. If your mortgage does not, you may be able to pay it off early, before maturity, either with a lump sum or by paying more than your required monthly payment and having the excess payment applied to your principal balance. Refinancing is also a consideration if interest rates drop from when you initiated your mortgage. Refinancing means borrowing a new debt or getting a new mortgage and repaying the old one. It involves closing costs. The lender will want an updated appraisal, a title search, and title insurance. It is valuable to refinance if the mortgage rate will be so much lower that your monthly payment will be substantially reduced. That in turn depends on the size of your mortgage balance. That concludes this presentation. I hope you enjoy reading the chapter.